Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day everyone. Episode 3, Series 3, Investing Insights of the Right Property Group. Phil Tarrant here, co-host, joined by my partners in crime, our regular panellist of property experts. Smiles on faces, but people involved in property, Steve Waters and Victor Kumar, directors of Right Property Group. Gentlemen, Happy New Year. Welcome. How you going? You good?
Good, mate. Happy New Year.
Do you have a holiday, Steve?
I get one a year.
Do you?
And it's now first day back.
First day back. Oh, wow. There you go. That's a good holiday.
Well, it's the only one I get.
Yeah, I
4 weeks.
What have you been doing? You've been anything property related, or you've been avoiding property?
Look, it's really hard to avoid it when you're every day. So there's always something to do, whether it's on my existing portfolio, a lot of repairs and maintenance over Christmas, as it just happened to be, or just analysing, really, different markets, different things, keeping tabs on the economy, everything that drives mindset for an investor.
How do you get your, other than listening to podcasts?
And of course, listening to podcasts.
Yes. How do you collect information? How do you absorb information? Are you a reader? Are you a watcher? And this is an interesting question because I get asked this a lot by other people, how I become educated around property. And my purpose of education, my process of education is chatting to guys like you, right? This is how I learn. How do you learn?
I read, and I read a lot of reports. I do a lot of numbers, and also I need to touch it and feel it. So a lot of immersing myself into different markets, locally, and doing whatever I can to actually distinguish what's truth and what's not, because numbers are numbers, but nothing beats actual ground truth, as we always say. You
still get out a lot yourself, don't you? I know you've got a reasonably big team now, Right Property Group, who are covering Australia, looking at property markets, but you still yourself, as you know, yourself and Victor, at the helm of this business, but it's still critical for you to be on the ground, right? So you can apply that knowledge you collect somewhere else where, in a real world.
Well, exactly. And it allows us to keep a pulse on the market and know exactly where it's at. And I think we did a podcast many months ago on the Perth market, I think it was.
Yes, that's right.
About what we thought and how we collate the information. And once again, ground truth's a lot of it, but we're out there all the time because everything is real. It's not just a statistic and it's not just data. And the only way that you really can find the pulse of the market is by being there.
And you, Victor, how do you sort of absorb information and synthesize it? What's your sort of mental process for doing this?
Well, certainly, podcast obviously is a big chunk of it, but I'm an avid reader, but I then translate that onto research on the ground. So if I've discovered a new area, I try and read up as many articles, as many reports on that area before I actually go there. And of course, also look at it retrospectively as well. So areas that I had picked that I was following, I'd go back 6 months later and see whether the opinions I had formed was actually correct or whether a few other things have happened in the market. So it's really important to differentiate and be mindful that as a researcher, that you're not only relying on desktop research, you're actually on the ground and validating the data that you've got. Because data can, depending on how you read it, data can be skewed so many different ways. And really, nothing beats, at the end of the day, correlating the data and putting a story behind it by actually being on the ground.
And you can see why people get analysis paralysis,
absolutely.
right? When you start to collate all the information and decipher it, there is so much of it out there. And if you don't have, or if you don't gain the experience learning to decipher it, well, the paralysis just sets in. It happens to me when I look for anything other than, or if I buy anything other than real estate, all the information that's out there, it blows my mind.
So Victor, there's when you're researching property, and I'm thinking this in a context of 2019, right? Like what's going to happen? So a lot of people have this same mindset right now. In the first month of the year, what type of information do you read? So you've got primary documents. So these are large-scale research reports or white papers or data and analysis that's done by large reputable institutions or governments. And then you have sort of secondary information, which might be other people's interpretation of that information. So when you go about the process, and the reason why I ask is because I get this asked question a lot to me, what do I read? So what do you read? as primary documents, and then how much weight do you apply on other people's
Opinions?
opinions or interpretation of that same information?
Yeah, sure. Before I even look at those reports, the very first documents or information source I look for is the actual state government resources. So what infrastructure they're putting in, what expenditure plans they have in the future, and then overlay that with the federal expenditure plan to make sure that the report that I'm looking at then is correlating back to where it's all going to start off from, which is the expenditure from the government to put in infrastructure, increase population, decrease population, make things more attractive for that area. And then it then makes sense when you're reading a report and just making a suburb up right now, just saying that Parramatta is going to do really well because of X, Y, and Z is what the report says. But let's say the state government is not going to spend money in that area. They were going to, but they've now halted that. We need to correlate the two so that we're talking about pertinent information that all gels together. It's not just one person's opinion that read a report from the state government, say, 2 years ago, and now has put it into writing, and it is very dated information. So the research has to be dynamic. What works last year, what worked last year might not work this year because we're now looking at different market sentiment. We're looking at different expenditure. We've got the election coming up, the federal election. So all of these things need to then play into the written reports, the documents that you're looking at, to make sure that we're looking at it from a holistic picture rather than just micro researching as well.
Summarize what you're saying then, you've got to be careful about where you securing information
Absolutely.
from and the process you use to make your own opinions against that sort of primary documentation. And a lot of people go down the process of reading something saying, yes, that's completely right. And so they're very positive about it, or as other people apply the logic of everything they read, they try and criticize or find an argument against it. So you've got to work out how
you have to find the supporting articles for it, the supporting factors for it to make it absolutely sure that what you're reading is what's actually going to formulate. And then again, still, it is very much a prediction at the end of the day because things could change overnight. The government could change their tune, the economy could turn, the investor sentiment could change as well. So we need to factor all those things in.
So it's nearly impossible to work out what's going to happen in property then. Is that how it works, Steve? Because this is what you guys do. This is your job, right? You support your clients through giving interpretations of markets and actually understanding their personal situation, what their objectives are, and then applying that to an actual transaction at some point, which is the acquisition of a property in a certain area. So there's quite a lot of stress put on you guys to be knowledgeable about everything that's happening, but then also sophisticated enough to pinpoint what to do and how to do it. And 2019 is a challenging market compared to past markets. If I think back to 2014, 2015, even earlier, buying something in Sydney was pretty straightforward and you're guaranteed a good return. But now we're in a market where, should you be investing in Sydney? So what I want to do today, Steve, is to do a bit of around the grounds. 2019, start of the year, understanding some of the markets across Australia and your and Victor's sort of sentiments towards those based on the research you've done and the ground truth, which is the term of yours, Steve, that you've had operating on the ground. But I thought we'd kick off with probably the most difficult market in Australia, Sydney. And I know Sydney's done the death at the moment, but it is our largest investable market in Australia and New South Wales. And it obviously attracts a lot of attention as a result of that. But 2019, the market softened quite a lot over 2018 in Sydney, as predicted. I think everyone's sitting around waiting for the market to bottom, and then they will strike. So from the research yourself and Victor have done on the Sydney market, when is it time to get in, and is it the right market to be getting into at any point in 2019?
Look, that's the $64 million question. When is the right time to get in? Into this, if we talk about the Sydney market,
We'll start with Sydney.
If we start with Sydney, look, we have actually purchased probably half a dozen properties in the last couple of months throughout Sydney, but they've been quite unique in what they are and quite opportunistic at the same time because we saw value there. To give an example, one was 28% below its peak, which was a phenomenal purchase, we thought. In fact, it goes back to 2014 prices for that particular property. So for us, that made good sense, and there was a couple others just like it. But that doesn't mean that that's just across the whole of the Sydney basin, so to speak. I think some areas will continue to suffer or contract, soften, whichever way you want to paint it up. But I believe there are other areas that are very close, if not have bottom. Now, all of this, Australia-wide, the market is going to be dependent upon finance. There are people that want to still invest. Lots of people still want to purchase. Whether they can get the money or not is the trick, is the key ingredient. But all things being fair and equal, if finance stays the way it is, then as I say, I think some areas of Sydney will continue to suffer, and there are some that have bottomed out. If not, they're very close. But I do think there's opportunity throughout the Sydney market, being very opportunistic, being very deliberate at the same time in what you purchase, and I think you'll see value.
Look, I think it's really important to understand that when you're buying in Sydney, the market has turned. So what would be a good buy or a good property to buy, say, 2 years ago, is definitely not the right type of property to buy in your portfolio right now. You need to, like you said, need to look at it from an opportunistic point of view, and certainly we need to also understand that the market may not have bottomed out in Sydney right now. Yeah, and so any property that you're buying, you need to have a medium to long-term outlook on it, and be mindful that if it did go wrong, you may, if you haven't bought really well and you haven't identified the opportunity, you may end up losing a bit of money, because you may not get the same price when you throw in your stamp duty and your legal costs and so forth. You may not get the same price that will get you to break even. So it's really important that people just don't jump back in just because the market has softened. This is something that we predicted years ago, that the market would go through its peak and then it'll soften, and that's the time to come back in. But it's equally important to understand that in New South Wales, in Sydney in particular, your yields aren't going to be there. So it's all about what the property can do.
And that was the next component I was going to talk about. Even though there might be opportunities to purchase, doesn't mean that you could necessarily afford them on the cash flow side of things.
Yeah, absolutely. Especially with the way finance is right now, isn't it?
Well, 100%. But I think if you can find something in Sydney West where you can build in the mitigation, the risk mitigation, by adding value to it. So something that's perhaps cosmetically challenged is an option, and create its equity that way, even though the market may compress a little bit further. I remember someone saying to me not long ago that you don't wait for shoes to come off sale before you start
Exactly.
buying them. And I thought that was a pretty good analogy with property as well. There's only so far the market can contract before it does represent extreme value or good value. And that's everyone else's unique opinion, I suppose. But for us, there are certain areas that'll do it.
So what sort of stuff do you buy in a city market if you are? Like, you're talking about opportunistic purchases and finding stuff that's 28% below its peak a couple of years ago.
Yeah.
They're hard to find.
So let's talk about that property then. So it was a purchase in the southwest of Sydney, and the purchase price was $415K. It was on the market a year ago for $600. It never was worth $600 to begin with, right? So deceased estate, the vendors finally became a lot more realistic, and probably worth, at its peak, it was probably worth around the 530 mark. So effectively, we've got a little bit more than $100,000 off it. If you look at it from its peak to where it is now, will it go down further? Maybe. It needs help in terms of renovation, in the sense that it certainly would help if we replace the blinds, replace the floor coverings, and gave it a coat of paint. The rent on it would be around the $400 week mark. But the opportunity on this, obviously, is the value on the property, but also the ability to put a secondary dwelling on it, so that this no longer becomes a heavy negative cash flow property. Once you put the granny flat on, it can certainly
In the medium term.
Yeah, in the medium term, yeah.
But what's also, in that particular case, which was attractive, was the ability to be able to evaluate with a haircut and a shave, as you call it, so that the risk mitigation there is in terms of its value. Secondary income there is another tick in terms of the mitigation, but also the fact that the land value for this alone was...
It's around $350.
Correct, yeah. And so it's below cost of replacement. But that's not a be-all and ever, because not everyone's capable of actually doing that, or would it suit their portfolio if they've got an existing portfolio. It's just merely an example of there is value out there. It's just identifying value and then being able to execute.
But this is an important point at which I wanted to raise: values in the eye of the beholder. So a property like that, would that be suitable for someone who is doing their first investment, or is it for someone who
Depends on their skill set.
Yeah.
Depends on their cash flow, their household cash flow indicators. Everyone has a unique position, and it may not suit everybody, but it will suit some people.
So that's Southwest Sydney. I'm sure you won't give me the suburb, because that's just
Ever the journalist, aren't you?
But I think just on that though, even though it wasn't the southwest corridor.
By the way, about 2 million people live out there. So
this is where I was. Choice. Yeah, I know, right? This is where I was going. I still believe there are portions of that southwest corridor that are at high risk. Yeah, there's probably 2,000 to 3,000 dwellings that are in the pipeline there that are either yet to be constructed or halfway through construction. That's going to put quite a lot of pressure on.
You have to take
on the
that into
supply.
account, isn't it?
Absolutely. And I think this is one of the indicators that whether it be Sydney, Brisbane, Melbourne, Adelaide, the Moon, we're always looking at sort of price, we're looking at population, and we're looking at performance as well. It's just the three factors that we're always looking for is how they're going to perform over the short, medium, and long term.
So I'm listening to this podcast going, yeah, that's all really good. That's very academic, guys. Thanks for skirting around where I should be buying or should I be buying in Sydney. How do I work it out? How do I go, that's good, that represents good value? How do I work out where I should be shopping around for a property if I am ready to invest? And being ready to invest is I've got finance and I've got, price points I can invest in, all sort of stuff. Tell me something really tangible about the Sydney market.
So what we're assuming that you've sat down and you know your own financial circumstances and everything like that, you're ready to pull the trigger on something.
Do I invest in Sydney?
And no.
Okay.
Oh, sorry, no, I'll take that back. Would I invest in Sydney if the right opportunity presented itself? Yes, because it's the strategy. It's what's the outcome I'm looking for, whether I'm buying in Sydney or Melbourne or Perth or wherever it may be, Brisbane. What's the outcome I'm looking for? And if Sydney's going to give me that outcome today because of the way I purchase it and how I purchase it and what price I got it for, then maybe yes.
So how to work that out? What are the trigger points then? So an outcome being I'm looking for capital growth, so therefore a Sydney play might work, or to Victor's point, I'm not going to get yields in Sydney at the moment because of the way the market is. But maybe that's a good thing as well, and that suits some particular strategy I might have around portfolio construction. What are the trigger points when every man and his dog is going to say, wow, Sydney is the place to be. Sydney is a hotspot. And Sydney's a big place, right? But
massive.
we're talking Sydney in general.
I'd be looking at pipeline, to be honest with you. I want to know what's in the pipeline.
In what? In infrastructure? Or,
No, as in dwellings. Because there is, and this is not just Sydney.
You're talking too many properties coming on the market, so it's saturated.
Under construction.
Okay, we're talking construction.
Yep. Or D8, and people have to build because it's more/less profitable for them to build than it is to actually not. So I'd be looking at the pipeline and it's not just Sydney, that's Australia-wide. Where and how many properties, if I buy this property A today, how many properties are in the pipeline that are going to be constructed or finished constructing over the next 12 to 24 months, and how does that look for me? How's it going to affect my value and also my cash flow?
So you're saying you should be looking at areas in Sydney, and we'll stick with Sydney a little bit longer, where the markets aren't going to get saturated. So properties where there is not going to be too many options for other buyers, whether they're homeowners or they're first home buyers. You want to be in tightly held areas where there's not a lot of construction going on. Is that a fair assessment?
To a degree, but also the property type, because we know that a lot of units are coming online. And so not all areas will suit units. And if you can, a lot of areas do suit units, but if you can get a house, it's even better. And that might represent value. So this is where dialing right in and going through the steps in terms of your diligence pays huge dividends down the line. So there's no use me going to Parramatta and buying another unit today, even if I get it at 28% of its price. It just doesn't represent good value to where my portfolio sits, and I'd suggest a lot of other people's portfolios for that matter. But if I could find, 800 square metres in the heart of Parramatta for 28% below its peak price, I might consider that because there's opportunity for me there in the future.
So it's always... It depends. Answer.
It is,
who you are, what you do. But let's try and let's give some tools for our listeners. Then the 5 key indicators, Victor, and whether it's Sydney or other markets in Australia. What are the 5 things that you should put front and centre of any property assessment that you do? So we're talking state, region, suburb, and property type. Now let's just 5 things which are nice and simple. I'm going to start with you, Steve. Start thinking about another one here.
The very.
I was just
Did you notice he came to me first, right?
Mate, you're better at this than Steve. So, by the way, we'll video this one day just so people can see just how organic this discussion is. So 5, Victor, number 1.
The very, very first thing that you need to assess is, what are you really trying to achieve? Are you just trying to, just get in the market because everyone else is, or is this going somewhere? Once you identify that, the very next thing then you need to look at is the state that you're planning to buy in. Is it going up, down, sideways? Because that will determine the type of property you need to buy. And then also get an understanding in terms of how the market cycle works in that state, and really right down to the suburb itself. Because if you look at Sydney in a generalistic term, Sydney goes 3 to 4 years of heavy growth, then it flattens out for about 2-3 years before it then starts ticking up. So usually goes in a 4 to 5 year cycles. So we need to understand that. So if you're looking at Brisbane as an example, it goes through longer periods in this cycle. So it goes through growth spurts of 2 to 3 years, and then it goes sideways for about 5 to 7 years. Now, I'm generalizing because each suburb is very different. So you need to look at those things before you look at any other factors, such as your cash flows, where you're going to get the loans from, and importantly, if things went wrong, how are you going to exit out of this? What's your exit plan? Map those out first, which is probably all 5 points all in one.
There's not much left for me.
Yeah,
here.
no, right?
No, I'm going to summarize that into that's more of a macro decision making. So understand cycles. Every market operates differently. You need to have an understanding, appreciation of how those cycles work to help pinpoint how your particular circumstances fit within the nature of cycles at any given time. So point number 1, understand cycles, macroeconomic type analysis. So
and understanding what you're trying to achieve.
And this goes back to our original point around what information you read or digest in order to make those decisions. And I'll give you point number 2, how your goal setting sits within the current environment in those particular cycles. So we've got 2 points there. Steve, point number 3.
Liquidity.
Okay, that's important.
Not just in a market, but yourself, because that will help determine where and how you invest.
Simple.
That was it. So I didn't need like 10 minutes.
Can you afford it? You're able to crystallise idea pretty quickly. So back to Victor then for number 4.
He's a man of few words. That's what he is. Right?
But you know what? It's a skill in property investment to be able to, and hence the reason why I want to get these 5 points, to be firm.
Yep.
Give me some guiding principles to help shape the way in which you research and make decisions. So the decision-making process is difficult. You end up with analysis paralysis and all that sort of stuff if you can't make a decision. Give me enough information to be firm about making a decision, and there we go. So liquidity being one of them. Victor, what else you got for us? Point number 4.
Straight on from liquidity, we need to be also looking at then the type of property we're buying, matched to our skill set, and how long it'll take before it becomes income producing.
Asset selection.
Yep.
Okay, and how do you go about doing that?
Well, the first thing you got to look at is
Go to point 1.
Yeah, point 1. Yeah. What type of property you're buying in this market to begin with? Is it an off the plan? I'll go and wash my mouth with soap in a minute for saying off the plan. But sometimes off the plan do make sense if the market is right. I'm not saying
Opal
that it
Tower,
is.
what a great,
Yeah, I
what
know,
a
right?
great investment. Would you buy? Sorry, would you buy one of them?
First of
If
all,
it's
I
cheap?
would not buy in a high rise
Yeah.
to begin with, right? It doesn't make sense in that unless I'm actually planning
Ever?
to live in there. I'd never say ever, right? Never say never, because if you got it for cheap enough and there's a clear exit strategy out of it, it would make sense.
So here's just straying from the topic. Would you buy one tomorrow for 50% of its original contract price?
In the Opal Tower,
Yeah.
I'd struggle because at the end of the day, I won't be able to offload it for 100% of its price.
Yeah.
Yeah.
So cheap sometimes.
Cheap does not mean cheap.
Yeah. Cheap sometimes is not good.
Are you getting to maybe your point number 5? It's value is in the eye of the beholder. So understanding value. Would that be a really good point?
No, I'm going to go back to one of the 3 Ps that we talk about a lot, which is pipeline. And I did briefly mention that earlier on, but pipeline's not just about construction and what's in the wings there, but it's also about where's the population coming from, how much population growth are we looking for in particular areas, or what does it represent to me? Obviously, the construction, what are the cash flow modelling, forecasts, infrastructure. So what's in the pipeline from every aspect that you can imagine.
And pipeline, and we'll stick with Sydney just a bit longer. Lots of things are changing in Sydney. The local governments are changing. They're amalgamating. They're merging. You've got new airports coming online.
We're in the middle of an
Greater West
infrastructure boom.
in the middle of an infrastructure boom. So there's lots happening. Your rail line out the northwest is just about to start working. I believe they're testing it. And
I saw one go past the other day.
oh, yeah, it's cool, isn't it?
I was like,
I haven't got a train for a long time, but it looked good. But that's interesting, and I challenge anyone listening who is from Sydney, get in a car on a Saturday or a Friday. You know what? Get in the car on a Friday afternoon about 3:00 and drive out there and experience what it's like to live out that way in terms of traffic and congestion and all that sort of stuff. But go and have a look at what's going on out there in terms of
infrastructure
construction.
there.
If you want to have a real inside view of an infrastructure boom and how it actually translates into the livability of an area during that transformation, it's a bit of a hassle, right, if you like traffic. But then what it's going to mean in the future. You go any of those rail stops along that northwest rail link and it's Univille.
It'll make a massive difference. But that's part of the pipeline scenario there. But on the other side of the pipeline scenario for that very same area is that if you take a suburb like Rouse Hill, which is in that northwest sector there, it's got something like another 2.5, don't quote me to be exact, 2,500 dwellings, along with Schofields, another couple of thousand that are yet to come online.
I went out Rouse Hill a couple of months ago, and I'd been out there. I'd sort of driven past along Windsor Road, but I'd never really been in there. It is a completely different way people are living these days. To me, it reminded me of like I don't know if
say it.
Like a Disneyland, you know,
I
like
think you were going there.
No, not as in like, you know, like a high street in Disneyland or, you know, Universal Studios where there's all these shops and places, and, you know, it's got that sort of feel about it. You live there, you don't need to go anywhere except for the train station to go in the city, maybe. Like everything is there. It's sort of very constructed feeling, you know. It all looks a bit, you know,
like it's a new city.
It's like a new city, but it's like I'm not going to say it looked fake. I'm going to say it looked manufactured, if that makes sense. And I think, and what I'm getting at is that I wouldn't want to live there personally, but I can see the appeal for people to live there. And it's changing the way in which Australians live. You know, this is not like white picket fence type stuff and you got your own quarter acre block, which was, you know, the western suburb of Sydney. That's what it was. All of Sydney was at a point in time. It's a very different way of living. So we have a changing population, a changing makeup demographic of Australia, in particular Sydney. And you think of pipeline, you need to be framing that in how Australians are going to be living in the future. I think
that's a good point.
There's a tipping point. I think in 10 years, I read in the paper over the weekend, there's a tipping point where more people are going to be born outside of Australia living in Sydney within 10 years than born here. So they're bringing with them the different changes in nature to how they live. And Rouse Hill is a really important point.
Well, we were having this conversation this morning in our in a team meeting. We were talking. Someone brought up about the baby boomers and where they're going to, how they've had an effect on the market and how they're also going to retract from the market as they get older, so on. Then we had the
X and Y's.
Gen X. Yeah, that smashed Avo and X and Y's and Gen X and everything like that. And I said, and for me, I made the point saying I don't think people are really getting a grasp that in 10 to 15 to 20 years' time, that all of this is going to be a different playing field again because of the levels of immigration that we've had and that we'll continue to have, and how these different melting pots of society will change the face and how we live, where we live, and the type of dwellings that will need to be constructed. I don't even think the building or the modelers have even nearly got it right yet.
They haven't. And going back to getting your car and drive out there, because I feel that Northwest Rail Link is a window into what future Sydney is going to look like, you know, moving forward. But irrespective of it's Sydney or anywhere else, those same dynamics are happening. It's happening in Melbourne as well. These arterial growth corridors and growth areas, the way they're building suburbs now isn't just a train station and flat blocks everywhere. That they are medium to high density, little mini cities in their own right.
But that's another good point, because you compared that to Melbourne. So if we do a Melbourne market update as well, if you look at Melbourne and try to compare it to Sydney in terms of the way that these new cities, we'll call them inverted commas, are being built, and new suburbs, it's really hard, and people always want to draw a comparison, Sydney and Melbourne, how they're similar, and they're not. Sydney is bound by mountain, sea and national parks. We've got a very limited envelope into which we can develop, hence why you've got that northwest corridor and down towards Badgerys Creek and all of those sorts of areas which are being carved up, because it's the last remaining land that we have that isn't affected by...
You can't go any further, right?
Yeah, that isn't affected by flood, fire, national parks, mountains or sea. Melbourne's a little different. There's a lot of green fields if you take Melbourne CBD all the way out to, say, Geelong as an example, which is and it is just paddock after paddock after paddock. So there's yet a lot to be developed there. So drawing comparisons on Sydney to Melbourne, I think, is actually quite dangerous.
But Melbourne will end up a bigger city than Sydney is, what all the data is saying at a
what
point
all the data, in time. Yeah, but
I can't remember when a tipping point
look,
is.
Look, this is where predictions come in, right? So if you dial back, I think maybe a decade, there's all these data modelling and all that saying that Perth is going to be bigger than Melbourne and Sydney. That hasn't happened because the economy changed. So we need to be mindful of that and not blindly follow these data and say that, you know, Melbourne's going to be bigger than Sydney and all that. We need to look at it right down from local economy and also follow the infrastructure boom as it stands right now. I've done a blog on infrastructure boom in Australia.
Where do I read that?
Yeah,
is it on your website?
Yeah, it is. We'll put it in the show notes.
Okay.
What you'll find is that Australia, as the developed country, is spending per capita the most amount of infrastructure dollars in the world right now. So there's a lot of infrastructure going in. And one of the key points that we need to make sure that we address is that whilst all of the fundamentals we need to look at, we also need to follow what's happening with the infrastructure and the impact it'll have.
Interesting. All right, so we touched on it very briefly. The investability of Melbourne right now in this market cycle. And going back to Victor's point, you need to understand every city moves at different cycles. Good place to invest.
I think
Is there
it's
any
12
trigger
months.
points that says it's ready?
I think it's 12 months behind, or 6 to 12 months behind Sydney's sort of peak that we had, and as a result of that, I think it's softening and contracting prices. It's going to be that
So
6
its
to 12
trough
lag.
will follow Sydney's trough as well.
Yeah, I believe so. Having said that, we're sporadically still buying down there and in some of the areas which are continuing to do very, very well.
What are those areas? You're not going to give me a particular suburb. What are they, what is the makeup of those areas where you're investing? What do they look like?
They look like locals would refer to it as regional. We don't, so it's like the Wollongong equivalent scenario, same sort of distance from the CBD. Would be a fair point. Yeah.
Okay.
Having said that, we think it's near its peaks, and that we change the tune into which we're buying or the type of property which we're buying. Whereas before, say 12 months ago, or no, maybe 24 months ago, it would have looked like sample A, but now it's the same area, but looks like sample B, just because the market dynamics are changing a little bit. And we like to withdraw from a market well before its peak, so that when it does soften, that we're still at a comfortable LVR to that new...
We're still in the money.
Trough, yeah, correct.
Still the money. And being in the money is Brisbane. Let's touch on that very quickly. We've got another couple of minutes. We'll keep going with this.
Sure.
Good, bad, indifferent, sideways, left, right, up, down?
Look, it depends on which side of Brisbane you go. So certainly if you went down, your Logan Way, this is where you'd only focus on opportunistic purchases only, and not just buy a stock standard property. Brisbane inner city ring certainly has got a lot of oversupply that's happened. Some that has now abated. The other areas that's still to happen, and then obviously. Anyone listening to this podcast would know about the Moreton Bay area and the university coming in and so forth. So depending on which side of Brisbane you're investing will determine the type of property. We need to be mindful that we are not expecting Sydney type growth or Melbourne type growth in Brisbane. We're talking a lower population. But understand that if we're looking at it from comparing it with Sydney, Brisbane at the moment is sitting at around the 70% below your 70% below your Sydney median price. Traditionally, it sits around the 26%. So there is a bit of growth to happen there, and with all this infrastructure going in and with loosening finance, we will see good growth. The $1 million question is when, but it's got some catching up to do.
I think the important thing there, Vic, that you mentioned is that people can't compare any other market's growth to Sydney or Melbourne. To do that would be foolish and dangerous because
that's where the major population.
Well, let's measure the growth. If we take Sydney and Melbourne, let's measure the growth, what it's been over the last 10 years in another couple of years' time, once we've finished that contraction, and then compare it to the rest of the market.
Absolutely.
Yeah. As we go around the ground for 2019 predictions, way out west, Perth, how's it looking?
Green shoots.
What's going on?
There are certainly green shoots there, and I think the industry in itself is trying to kickstart perhaps Perth's market as well. Trying to say as many positive things about it as they can. That aside, there is some green shoots over there, and there is some fundamentals that are starting to shine through in certain areas, and very, very few areas at that, which we have been purchasing in. And once again, we're quite opportunistic and deliberate in what we're looking for. I don't think it's a new investor's market. I think it's someone who's looking to add to their portfolio for diversification. You certainly wouldn't be going there for cash flow, because that's quite poor. But value adding and medium term, and obviously always long term growth, there are some areas there which do have the green shoots. But just remember, it is a long way to go there, and everything is more expensive. Property management's more expensive, repairs and maintenance more expensive. So the actual bottom line to your numbers is important.
Back east, Victor, Tasmania, Hobart, Launceston, the great state of Tasmania.
Look, I've been on record as not being a fan of Tasmania, and my opinion still stands.
You get any hate mail?
I do. Yeah, but I live with it. Yeah. The reality is that look, any market that you look at, you can always find good opportunities if you look hard enough. But it's just that you need to be mindful of, easy to get in, not so easy to get out. Yeah, we need to understand that. And with Tasmania, we've had a surge of growth. But if you look at it from a historic point of view, every time Sydney and Melbourne has done really well, Tasmania follows. It's get its growth spurt. But we don't have that ever increasing population. It's an aging population. So that's what we need to keep in mind. I'm not saying that you should not buy there, but if you are buying there,
we did.
you need to.
We did a little bit, but we also we think we picked the market, and by saying, well, now it's time to get out. A little bit like Geelong in Melbourne, where
absolutely.
We got in well ahead of Meltons and so on, and then knowing that it was a short play for us, we get in, we saw the growth, and then we moved the money on elsewhere.
I've heard good reports around getting to the territories, Canberra as an investable location at the moment. Your views towards that?
Look, Canberra's it's very expensive in every which way you look at it. Purchase price, ongoing
land tax
holding
is a
costs,
killer
land
there.
tax. I think it's always going to do all right. It's a service state, and if you bought in close to the CBD, well, then you'll do all right. We've done very well just on the northern part of the border there, so coming into Queanbeyan, which is New South Wales, so we save on taxes. Still a short drive into the CBD of Canberra, and that's done very, very well for us. So Canberra, yep, look, it's okay. It's just not our sweet spot.
Darwin, another territory. Oh, I hear they're trying to merge maybe with South Australia, I heard on the grapevine, but to turn into a state. But what's your thoughts of Darwin / Northern Territory, which really is Darwin, maybe Catherine? I don't know if you want to be down there.
Look,
but
now, population of less than 1 million.
Yeah.
It's too big a land expanse. You close down half the year because of the rains. Certainly not my pick. Again, there are better opportunities in the bigger markets.
Good fishing.
Good fishing. and there's the point, where you're going to get the great use and
That's
utility
right,
of your money, and is it in Darwin or anywhere? That's the decisions you need to make. So when we look at that in that same context, South Australia, Adelaide
Adelaide
what do you
always
reckon?
done.
By the way, I watched a really good, maybe it was 60 Minutes or something about Whyalla the other day. That was a really interesting story. But I sat there and I was watching that show thinking about you guys, and next time we get together, how industry is so inherently connected with property values. And if you don't know the story of Whyalla, it's huge steelworks there. I think it produces, 60-70% of Australia's steel. Steel markets have changed quite a lot, where rather than just doing big girders now, it's all quite bespoke. So it was really struggling. There was talk about they went into administration, the steelworks there, and everyone's property prices just plummeted, So people's jobs were at stake, and then also all their wealth and their properties were at stake. So how connected in industry is with property values, and South Australia is one of these areas. Once you get out of Adelaide, a lot of it's connected with single industries.
Absolutely.
Right?
Well, you go to Elizabeth.
Elizabeth
in the car manufacturing, which has suffered.
I think
You guys like Adelaide.
Yeah, we like Adelaide, but the key is that you want to be investing fairly close to the CBD in this instance, so not more than 20 minutes away. That's your ring that you'd invest in. Any further, you haven't got the population support, and also then you're very, very dependent on just the one or two industries in that area.
Good. You mentioned that you're going to send us to an article somewhere where we can read a little bit more about this sort of
It's
stuff.
about infrastructure, yep. So
Okay,
we'll
around
put it in the
infrastructure
link.
spend. Is that specific? Is that just in general, or is that specific to any state?
It is across Australia.
Okay.
So what's being spent in which state?
Okay, so go and check out the show notes. Click on that, and you can read more about it. I think it's really hard to do a bit of a round the grounds 2019 in such a short period of time, but we've just done some top level ideas. I think the 5 points that we made around how you go about shaping where you invest and how you do it aren't relevant to any particular state. It's Australia wide. So look to embrace those where you can. I want to move on. Victor, if there's any questions people have got around this sort of stuff, infrastructure and how they should be investing, where do they go?
So questions@rightpropertygroup.com.au.
Okay, and you're happy to take any questions and you'll get back
Sure
to people
can.
as required. That's cool. All right, so I just want to get to our question of the month, and this is from Amy. And Amy writes, with the interest-only cap being taken away within the banks, is this going to impact on my ability to get finance?
Short answer is no. Nothing really changes. Serviceability calculations are still serviceability calculations. The cap is just the amount of interest-only loans. Doesn't affect you personally yet.
Okay, so if people aren't familiar with what this interest-only cap is, Victor, what is it?
So the regulatory body, APRA, had brought in a regulation where a lender, a deposit-taking institute, could only have 30% of its mortgage book as interest only, and the rest had to be principal and interest. So that impacted a lot of people, particularly the ones that were rolling off their interest-only period into straight into a principal and interest. They couldn't be reset into interest only. Now the regulator has now taken off that handbrake, and now there is no cap on interest-only loans that the bank can give out. However, they have not taken off the qualifying rates or anything like that. So nothing's really changed apart from the fact that the bank can actually give out more interest-only loans.
What I've read around this is that the banks have had a bit of a tap on the shoulder from the regulators saying, okay, maybe you can start softening a little bit the credit criteria. Are you seeing that in the work that you're doing with your customers who are securing mortgages? Or is it still as stringent?
There is. So, your 90% loans are coming back in and certainly if you look
some
at
attractive rates as well.
Yeah, very much so. And if you look at it historically, we've gone through this before, right? So we had finance that became really difficult, and they eased it out. Then they eased it out a bit too much. The property market starts, on a runaway express train. Then they try and put the brakes on again through different ways. This time around, they used finance as the way to put brakes on. Maybe next time around, they may use the interest rate as a way to stop it. But right now, I think there'll be further softening of finance. At the end of the day, when the property market does well, the economy does well.
I think, and the RBA is absolutely petrified at the moment around the dropping house prices throughout Sydney and Melbourne in particular. They're actually saying if Melbourne really follows Sydney's suit, this is going to play havoc on consumer sentiment and spending, and that whole scenario then plays out with talk of perhaps interest rate cuts from the RBA. That's yet to be seen, but at the end of the day, this isn't new. This happens every cycle. 4 or 5 years. It's just the same thing.
And at the end of the day, I think one of the things that the listeners need to take away is that don't panic if your property's gone back in value. So long as you're able to hold on to it, it'll come back up again. And this is just a temporary thing, and it's normal cycles.
So we're talking about cycles in terms of property was our point number one. You understand cycles, but there's also a financing cycle that goes hand in hand with property cycles. They're interconnected and linked. Yes. What happens with finance plays out in the cycles of markets across Australia. So we're in a finance cycle now. We've gone through a period of tightening, credit tightening and regulation tightening, and it's starting to soften a little bit, and these all work in unison. So,
just to give some perspective to the finance cycle, because I think that's a really, really good point. The last time Sydney saw or New South Wales, Sydney, Melbourne saw price contraction like we did was when rates were 15, 16, 17%. Usually when we see a contraction of price, obviously it's because interest rates go up, not at record lows where we have now. So that in itself is quite unique. The fact that the cycle rolls round and round and round isn't unique. There's just a different trigger most times.
Okay, I think we've done a pretty good job for episode 3, series 3, Victor, of the Investing Insights of Right Property Group. Any closing remarks from you? Any thoughts of brilliance which you normally have? Okay, I've listened to this podcast. Yes. Okay, that's really cool. What do I do now?
Fantastic. The very first thing you got to do is sort out what you really want to achieve out of investing, and then reach out. If you want to reach out to us, it's questions@rightpropertygroup.com.au. Go to our Facebook page, or come to one if you're in Sydney. Come to one of our events. The next live event is on the 26th of February at Parramatta Ridges.
Open forum.
So register for that, and you're welcome to attend.
And Steve, hypothetical, you've just listened to this podcast, and you're a property investor. What's the first thing you should do with the knowledge gained?
Reassess your portfolio on its numbers, and that'll give you some pretty clear direction.
The numbers never lie.
The numbers never lie, whether that be finance or equity or cash flow.
Brilliant. All right, gentlemen, thank you very much. I appreciate your time, and we'll be back again next month with Investing Insights of the Right Property Group.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.